Hey, hey, hey. What's up?
Okay guys, welcome back to the channel. Today I've got two CoinDesk articles for you on what a stablecoin is and what the point of a stablecoin is. Okay, now let's get into the video. Okay guys, so you may be wondering what a stablecoin is. So a stablecoin is a type of cryptocurrency whose value is tied to an asset such as the US dollar or gold to maintain a stable price and value. A stablecoin is a type of currency whose value is pegged to another asset class such as fiat currency or gold to stabilize its price. Cryptocurrencies such as Bitcoin and Ether or Ethereum offer a number of benefits, and one of those most fundamental is not requiring trust in an intermediary institution to send payments, and this opens up the use to anyone around the globe. However, the one drawback is that cryptocurrency prices are unpredictable and have a tendency to fluctuate, and often wildly. This makes them difficult for everyday people to use. Specifically, people need to be able to expect how much their money will be worth in a week from now, both for the security of themselves and for their livelihood as well. So with cryptocurrencies such as Bitcoin and Ethereum, the price fluctuates quite largely and quite a lot. So you're not sure what the value of that cryptocurrency is going to be worth in a week's time. So that's where stablecoins come in. Now, cryptocurrency's unpredictability comes in contrast generally to the stable prices of fiat money such as the US dollar and other assets such as gold. Values of cryptocurrencies like the dollar do change gradually over time, but on the day-to-day basis, they do not change as drastically as cryptocurrencies, which rise and fall regularly in value. Now, the following graph shows the price of Bitcoin versus the US dollar compared to another fiat currency, the Canadian dollar, to see how much each currency fluctuates in valuation. So here you can see the blue line is BTC to Canadian dollar, so that is wildly fluctuating here, whereas you can see that the US dollar is the yellow line just behind it, which does not realistically move at all when compared to Bitcoin. It is still fluctuating, but not as much as Bitcoin, okay? Now let's have a look at stablecoins in a nutshell. So stablecoins try to tackle price fluctuations by trying to value cryptocurrencies to more stable other assets, usually fiat currencies. Now, fiat is the government-issued currency that we're all used to using on a day-to-day basis, such as euros and dollars. Now, usually the entity behind a stablecoin will set up a reserve, and this is where it securely stores the asset or the basket of assets backing the stablecoin. For example, $1 million in an old-fashioned bank would be the reserve of the bank so that they can move the money backwards and forwards, and they can have it as a stable reserve for the dollars. Now, this is one way that stablecoins are pegged to real-world assets, but the money in the reserves serves as collateral for the stablecoin, meaning that whenever the stablecoin holder wishes to cash out their tokens, an equal amount of whichever asset backs it is taken out of the reserve. So this is key here. The reserve should act as a one-to-one parity between the fiat and the collateralized reserve currency. So essentially, if you took $1 out in real fiat, you would then have to take $1 out in the cryptocurrency stablecoin to then make the parity the same for both currencies for it to be stable. Now, there are more complex types of stablecoins that are collateralized by other cryptocurrencies rather than by fiat, yet they are still engineered to track a mainstream asset like the dollar. Now, Maker perhaps is the most famous stablecoin issuer that uses this mechanism. It accomplishes this through a service called the Vault, formerly known as the collateralized debt position. This locks up a user's cryptocurrency collateral, and then once the smart contract knows the collateral is secured, a user can borrow a freshly minted DAI, which is the currency of the stablecoin. So you have to lock up a cryptocurrency's user collateral, And then once the smart contract has validated that, a user can then borrow a freshly minted amount of the new stablecoin. Now, the third variety of a stablecoin is known as an algorithmic stablecoin, and this is not collateralized at all. Instead, coins are either burned or created to keep the coin's value in line with the target price. Let's say a stablecoin drops from the target price of $1 to 75 cents. The algorithm will automatically burn a tranche of coins to introduce more scarcity, pushing up the price of the stablecoin. This type of stablecoin is difficult to get right and has been tried and failed several times over the recent years, yet entrepreneurs keep trying. Now, the most common ones of this is Terra and Terra Luna, okay? And it was a working example up to a couple of years ago, or last year, and a couple of months ago as well, when it collapsed. But Terra is not working anymore, so don't invest in that, okay? Terra crashed out and burned a lot of people along the way, so I would not get involved in that project personally anymore. But that's not financial advice. Do with your money what you will. Now, different types of stablecoin collateral. So in the framework of stablecoins, there comes a range of flavors and different types of collateralized stablecoins which you can use. Fiat is the most common of the collateralized amounts for the stablecoin, and it is the US dollar which is the most popular among fiat currencies. However, companies are exploring other stablecoins pegged to other fiats as well, such as B Lira, which is pegged to the Turkish lira. Now, precious metals. Some cryptocurrencies are tied to the value of precious metals, such as silver and gold. Cryptocurrencies. Some stablecoins are even pegged to other cryptocurrencies, such as Ether, the native token of the Ethereum network, as collateral. And there are collateralized other investments as well. So Tether's USDT was once supposed to be backed 1-to-1 with the dollar, but its collateralized mix has shifted over time. In a breakdown provided in 2021, the company said nearly half of all its reserves are collateralized in commercial paper form, or a short term of corporate debt. It has not disclosed the issuers of this paper, but claims it is all A2 rated or higher. A2 is the second best grade for corporate borrower ratings in credit from agencies like the Standard & Poor's Index. Now, Circle's USDC similarly lists unspecified approved investments alongside accounts at federally insured banks. Notably, it does not say where the accounts themselves are insured in its monthly disclosures. So just be careful with those type of ones, okay? Now, Tether is the most common and most popular of the stablecoins, as it is one of the oldest stablecoins, as it was launched in 2014, and it is still the most popular one to this day. It is one of the most valuable cryptocurrencies by overall market capitalization, and the primary use case for USDT is moving money between exchanges quickly to take advantage of arbitrage opportunities when the price of cryptocurrencies differs on two exchanges. Traders can make money on this discrepancy, but it has also found other applications, such as Chinese importers stationed in Russia have also used USDT to send millions of dollars worth of value across the border, bypassing strict capital controls in China. Tether Limited, the company that issues USDT, was embroiled in a 22-month legal battle with New York US Attorney General over allegations. Bitfinex, a sister company of Tether, tried to cover up an $850 million shortfall using funds taken from Tether. Eventually, the case was settled on February 23, 2021, with Tether and Bitfinex forced to pay $18.5 million and submit quarterly reports showing Tether's stablecoin reserves for the next 2 years. So that bottom half of that little bit there was just talking about the court case it was involved with in the legal battle. But essentially, because cryptocurrency exchanges aren't banks, you cannot send fiat to it from one exchange to another exchange. So the way people get around this is they use currencies such as stablecoins like USDT to send money from one exchange to another exchange. And this way they can then transfer it back into a cryptocurrency, or which they can buy a new cryptocurrency which they couldn't get on the current exchange. USD coin, or USDC, is a stablecoin that was launched jointly by cryptocurrency firms Circle and Coinbase in 2018 through the Center Consortium. Like Tether, it shifts forwards a mix of collateralized assets. USDC coin is pegged to the US dollar, one-to-one, allegedly, and it is an open source protocol, which means any person or company can use it to develop their own products. On July 8, 2021, Circle announced plans to go public through a $4.5 billion SPAC merger deal with Concord Acquisition Group. The news came 1 month after Circle closed a $440 million funding round involving big industry names such as FTX, Digital Currency Group, the parent company of CoinDesk, Fidelity Management, and Research Company. Now FTX has since collapsed, and DCG is in a little bit of hot water at the minute, so we'll see how this goes. But yeah, USDC coin right now not looking the greatest investment, but just do your own research before you invest in any coin. Doesn't matter whether it's a stable coin or not, okay? Now DAI. Running on the MakerDAO protocol network, DAI is a stable coin on Ethereum blockchain, okay? It was created in 2015, and DAI is pegged to the US dollar and backed by Ether, the token behind Ethereum. Unlike other stablecoins, MakerDAO is intended for DAI to be decentralized, meaning that there is no central authority trusted with control of the system. Rather, Ethereum smart contracts, which encode the rules, can't be changed, and they have this job instead. Now, there are still problems with this innovative model. However, for example, if the smart contracts underpinning MakerDAO don't work exactly as anticipated, they could be gamed and led to a loss of $8 million in 2020. Now, do stablecoins have any drawbacks? Now, there are a few drawbacks to keep in mind for stablecoins, because the way stablecoins are typically set up, they have different pain points than other cryptocurrencies. If the reserves are stored with a bank or some other third party, another vulnerability is counterparty risk. This boils down to the question of, does the entity really have the collateral it claims to have? And this has been the question frequently posed to Tether, for instance, over whether it maintains a true one-to-one backing between USDT tokens and the US dollar. Now, in the worst case scenario, it's possible that the reserves backing a stablecoin could turn out to be insufficient to redeem every unit, potentially shaking confidence in the coin. Now, cryptocurrencies were created to replace intermediary companies that are typically trusted with a user's money. But by their nature, intermediaries have control over that money. For example, they are typically able to stop a transaction from occurring. Some stablecoins add to the ability to stop transactions back into the mix. And that's important because it was one of the key selling points of cryptocurrency, was that no one could stop you from transacting on the blockchain. But USDC openly has a backdoor to stop payments if coins are used in an illicit manner. Circle is one of the firms behind USDC and confirms that in July 2020 it froze $100,000 at the stablecoin at the behest of law enforcement. So USDC is very much on the traditional finance side of things. It's not really a true cryptocurrency in that it does not let you just let you use the blockchain if you are anyone. If the police or the federal government say you're not allowed to use it, you're not allowed to use it. So there you go. But coming across to our second article for today, it's another CoinDesk article, but it is talking about what the point of stablecoins are and the risks behind them. So recently, regulatory moves concerning Paxos, the issuer of Binance's US dollar pegged stablecoin, BUSD, have brought renewed focus on stablecoins, as the asset class within cryptocurrency is meant to provide a haven for the highly volatile nature of most other cryptocurrencies. The investigation on Paxos has also reportedly caused payment giant PayPal to pause development on its own stablecoin, which has led many to wonder what they need to know about stablecoins to understand the news. Now, we've already just gone through this in the last article, but you may already know that stablecoins are basically dollars in digital form, except it's not exactly true, because stablecoins can be algorithmically tied to any type of fiat or government currency, as well as other forms of digital assets like gold and silver. Now, no matter the type of stablecoin, they exist to make cryptocurrency more predictable. Now, while predictable cryptocurrency sounds like an oxymoron, stablecoins, like their name suggests, were designed to counter crypto's hallmark volatility and provide a convenient way for traders to preserve their fiat value without having to cash out of the market, and allow users to pay for everyday goods and services in crypto without budgeting drama. Now we're just going to run through this really quick, this section, which is how the stablecoins work. Stablecoins generally work the same across the board. They are cryptocurrencies minted on the blockchain that users can buy, sell, and trade on an exchange, just like any other crypto coin. People can store cryptos and stablecoins in their hot wallets and or cold storage devices like they would any Bitcoin or altcoin. In order to have integrity, most stablecoins are linked to a reserve of external assets of some kind, whether that be a stash of fiat commodities like gold or debt instruments like commercial paper. In most cases, the company or entity that develops a stablecoin owns the reserves equal to the amount of the stablecoin that it has in circulation. This is such that any stablecoin holder should be able to redeem one stablecoin token for $1 at any time. Now, the four types of stablecoins that we've just gone through are fiat-backed, cryptocurrency-backed, commodity-backed, and algorithmic. Fiat-backed is a 1-to-1 ratio between the fiat coin it is pegged to and the stablecoin itself. So USDC is an example of this, where fiat is backed and pegged to the dollar at a 1-to-1 ratio. And there can be other coins as well, such as the Japanese yen and the Chinese RMB. Now, cryptocurrency stablecoins are backed to other cryptocurrencies, and they are pegged to the value of an established cryptocurrency as well. For instance, MakerDAO, we've just gone through this, but it is one of the most popular cryptocurrency-backed stablecoins, as it uses smart contracts to validate this. It is a self-executing code-based contract alongside the Ethereum protocol pool of enough ether to use as collateral for its stablecoin. And then this amount of collateral, once it reaches a certain level, the smart contract mints a DAI, or the native stablecoin for that blockchain. Commodity-backed coins, as it describes, use commodities for the stablecoins. We went through this just a minute ago, but it uses precious metals, industry metals, oil, real estate, gold, all the lot. Commodities love the option of commodity-backed stablecoins because it allows them to invest in gold without having the hassle of sourcing and storing it. As an example of this commodity-backed stablecoin, they use it in the Switzerland vaults, as it is a backed reserve. 1 ounce of gold is equal to 1 XAUT, which is Tether Gold. That's a awful ticker, but there you go. Algorithmic stablecoins. They are not backed by any real-world commodities. This is a category of stablecoins that use algorithms to modulate the supply based on the market demand. In short order, these algorithms automatically burn and permanently remove coins from circulation or mint new coins based on fluctuating demand for the stablecoin at any given time. You can think of an algorithmic stablecoin as a bucket of water left outside with a water level marked on the inside. You keep the water inside the bucket at exactly the same level. You set up a mechanism that adds or removes water depending on how far the water level has deviated from the mark. This is controlled by a computer algorithm such that if it rains and the bucket begins to fill up, the algorithm instructs the mechanism to release the water out of the bottom of the bucket until it reaches the water level mark. Oppositely, if it is a hot day and water evaporates out of the bucket, the computer algorithm will instruct a mechanism to add more water to the bucket until the correct level has been maintained. I quite like that one though. That's quite a good way to look at an algorithmic stablecoin. But anyway, there's been a lot of trial and error with stablecoins on the quest to successfully introduce algorithmic stablecoins to the crypto ecosystem, and the fail of Terra UST, which is what we spoke about briefly, shows how badly things can go if the algorithm is not stable or is not able to keep up with the dramatic swings of the cryptocurrency markets. Now, this was the bit I wanted to look at the article for, which is why do you want to bother using stablecoins when you can just use a normal cryptocurrency? Stablecoins are designed for the global economy and theoretically solve a few key problems that inhibit the exchange of money. Stablecoins do not need multiple international bank accounts to send crypto to friends in other countries. You need one crypto wallet. Stablecoins make true peer-to-peer digital transfers possible without the need for third-party intermediaries to facilitate transactions. Now, in theory, stablecoins cut down on the fees, transfer times, and potentially privacy infringement we've grown accustomed to under the new paradigm for central banking. Say you were a Chinese business owner, bit out there, but I know, and you wanted to pay an invoice to a client in Japan who also had subcontractors in Europe. You will need to find a Chinese bank account with a Japanese bank account. You would need to have a Chinese bank account, a Japanese bank account, and a European bank account. And this is explained by William Quigley, the co-founder of Wax Blockchain, one of the co-founders of USDT, the issuer of Tether. If somebody wants to send you euros or yen or RMB, the intermediaries who can hold those accounts swap them out for currencies of the currency you are able to hold and then send it to your bank. Along the way, they've skimmed a lot of money off the top for that process. Now, rightly so, Quigley says we can't all have 50 different bank accounts in 50 different countries, but with stablecoins, there is no need. Privacy lovers in particular appreciate the faucet of stablecoins since they can avoid the process known as KYC, or Know Your Customer, aka submitting photo and social security information to a financial account. While KYC has become normal for most of us with dealing money and cryptocurrency proponents, KYC is prohibitive when it applies to central banking in institutions of other countries. Now, this is extraordinary. This is quoted from, I assume, Quigsy as well. But this is why it is extraordinary to me that an individual in New York, California, or Texas can hold their ledger wallet and 10 different tokenized currencies in their native form. It is by Quigley. Look at that. Now, you can keep a token representing that Chinese currency and use it as though it is a Chinese currency without ever converting it. This is a direct peer-to-peer model of stablecoins, and it helps to save money that otherwise would go to pay processing fees and administrative costs for third-party intermediaries. Now, there is $1 trillion each year siphoned out of the global economy from businesses and consumers to these money changers. Quigley also said that. And this disappears if the currency can be maintained in its original form because it has been tokenized and held on a blockchain, accessible to the user instantly rather than in a bank. Now, how do you pick the right stablecoin? There's the question you want to know. There's a wide variety of stablecoins now available within the broad ecosystem of 16,000 cryptocurrencies. People, man, we only need about 30. We don't need 16,000. But anyway, just choose which one you want to buy, trade, or simply use for everyday transactions remain a challenge even for experts. I would argue if you're experts, it's not a challenge, but there you go. As with all things, there is a perpetual balance to keep in mind between centralization and decentralization, stability, freedom, and regulation, permissionlessness. Okay. Fiat-backed stablecoins, for instance, are popular because they are as stable as a US dollar or widely accepted currencies. However, linking crypto to a federal currency makes a fiat-backed crypto a target for governmental regulation and overall more centralized. A certain trade-off when compared to algorithmic stablecoins, the most decentralized option. However, so far with Terra, algorithmic stablecoins will destroy your bank account and you will be left with no money because the algorithm does not work. There's also the issue of exactly backing of each currency. For instance, not all USD-backed stablecoins, USDT and BUSD, that is Tether, and that is Binance US dollar, to name a few. They are backed by an exact 1-to-1 ratio of dollars. This is not backed by an exact 1-to-1 ratio of dollars to crypto. Now, what's inside their reserves depends entirely on the entity behind the coin. USDT, or Tether for instance, is used to be set up where the dollar amount in the reserves was identical to the amount in minted USDT, but this has changed, says Quigley. Adding what Tether, the issuing company, has done now, they have a certain quantity of outstanding Tether held in fiat, held in liquid marketable securities. So instead of dollar bills, there might be liquid reserves on the form of bonds, CDs, collateralized debt, that is, treasury bonds and cash equivalents. I was like, CDs? But no. Collateralized debts. Now, another difference on platforms and exchanges you can find of each stablecoin. Binance, for example, announced in 2021 or in 2022, sorry, that it would convert USD coin into its own stable BUSD. Now, in the last couple of days, BUSD has been getting smoke from the Federal Reserve and from the SEC about unregistered securities, and they have stopped minting it, or Paxos have stopped minting it, which is the company that mints the stablecoins. But when considering a stablecoin to add to your portfolio, consider these questions. Where can you buy a stablecoin on an exchange? What platform is a stablecoin minted? How often are the reserves audited, and how transparent is the reporting? And what is the market cap of the circulating supply? Key questions. Yes. Now that is the end of this article and the 2 articles for today's video. I hope you guys did enjoy it. I tried to put a little bit of a different take on it to see if anyone would like that a bit more, but let me know in the comments down below, and thank you for watching guys, and I hope you have a good day.